Hi guys, how's it going? It's Albatam Chagi and welcome back to my YouTube channel. This is an invest with me video, so I will be showing you guys my January investments. The goal is still the same, to be consistent and stay in position, because that's the least that I can do. I cannot time the market, but what matters is my time in the market. And guys, remember that none of my videos constitute as financial advice. I'm just on here sharing my journey. Don't take this as financial advice or investment advice. So I'm going to start with my ZAR account, and I'm planning to mix non-dividend paying ETFs with individual stocks. I have already added the tech S&P 500, and I want my individual stocks to weigh less. It's going to take a bit of time because I rent cost average, so I will need to put some extra money into this ETF to rebalance this portfolio. I will eventually get there, but it will take time. What I want is for my portfolio to perform better, and as I have said in my previous video that I had focused on dividend investing strategy, so I am doing things a bit differently this year by investing more into growth ETFs. And I have decided to be intentional with my portfolio splits. I will be investing 25% of my money into the ZAR account and 75% into the tax-free savings account, and 25% of 3,000 is 750. I've already deposited the money into this account, so I will start with individual companies, then invest the remaining into the S&P 500 tech info. I'm going to start with First Rand, and I looked it up on Simply Wall Street. This is where I check the performance of companies and where they stand, valuation, dividends, and all of that. And the dividends are well covered by its earnings. And remember that in times of high interest rates, banks tend to perform way better because they benefit from high interest rates. And the fact that earnings can cover dividends is a 10 for me, because it proves that they are able to afford the dividends that they pay out. So I'm going to buy only one share of the stock as usual. I don't buy a lot. And one share currently is 67 rands. Just rounded it off. So I'm going to go ahead and buy. And the second company is Pick n Pay. The past year's performance is really bad. It is down 54%, but I recently bought it. That is why I'm up 4.91%. But you know that the situation is really not good with them, but I will keep on buying, as I've mentioned in my previous videos that I believe in the business. And according to Simply Wall Street, earnings are forecasted to grow by 74.21% per year. They just said per year. I don't know starting from which year, but we will see. And should this happen for real, then the stock performance should improve. So I'm going to buy only shares worth of 50 rands. And 50 rands gives me 2 shares in Pick n Pay. And honestly, for companies that trade at less than 50 rands, I always buy 2 shares, because I feel like, okay, I can afford a bit. So with this one, because the one share price is 23 rands, I have bought 2. The thing with me is I understand the figures. I believe that the financials should speak for the company. As an investor, you should be interested in the company's investments plans to expand their operations, and this should show in their finances. They should improve. Say for an example, Pick n Pay plans to open 10 more stores, so we expect those stores to be profitable and improve the entire group's profits. If they don't, then it was a bad investment. Even worse if they took debt to finance that investment, because then the return on investment will be less than the cost of capital incurred, which is a huge loss. And the next company is Premier Group, and I'm going to buy 1 share. And apparently this one is undervalued by 6%. This means that the stock is cheap and it is expected to increase by more than 6% in the future, meaning that the share price should be way more than what it is today. So I'm going to buy 1 share, which is trading at 70.5 rands, and I'm going to say 71 rands, and that should give me 1 share, also because it's more than 50 rands, as I've said. And the next one is Tungela Resources. I am down 22.94%, and I'm just wondering how much did the people that bought it years back lost already. So one share is trading at 153, and I'm going to buy one share of it. And the share price has been declining because the mining industry is facing some issues. So we'll see how the stock performs when Transnet sorts out its issues and commodity prices improve. So we'll see if the company will bounce back or not. So I'm going to go ahead and buy only one share. And the last one is Zeda Limited. I'm also going to put in 50 rands, which gives me 3.9 shares, and I'm going to buy it open. So I'm done with my individual companies, and I have 308 rands remaining to invest. And as I have said that the remaining amount, I'm going to put it into the S&P 500 Infotech. So that entire 300, I'm going to invest into this ETF. And then I'm going to move to my TFSA to invest in the ETFs. And I have 2.250 to invest, which is 75% of the 3,000. So I have done this a spreadsheet that helped me compare my ETFs and decide on how much I'll be investing in each one of them. I have ranked them according to their past year's performance and not dividend yield. Even though I have included it, I just wanted to know how much the yield is for each ETF. And I just feel like with ETFs being hyped up to be the safest and easiest way of investing, sometimes we just invest without knowing how much we are getting from them because we prioritize safety. But it's also about money, guys. You need to know how much you are getting in return for your investment. So it's important to assess which ETFs are worth it according to what you are investing for and why you are investing. So my top 3 best performers are the S&P 500, Nasdaq 100, and the first rent global 1.2, and I'm going to invest 350 into these 3 ETFs and 300 into the property ETFs, which are the One Invest SA Property and Signia Global Property, which have both yielded positive returns in the past year. And then I'm going to invest 200 into the Cetrix ETF, which are all on a negative. So I'm going to start with One Invest SA Property, and this one pays a decent dividend yield of 5%, which is very fair. I chose this ETF for dividends. If you think about it, in reality, in real life, you would buy a property for passive income, usually, right? Let me not say generally, because you'd find that somebody buys to flip them. So usually people buy property to and passive income, and it's actually the same with property ETFs. It should be for passive income. So I'm going to buy 300 worth of shares, and it gives me 8.7 shares, and then I'm going to buy it open. And the next one is the first trend global 1.2 ETF, and I'm going to invest 300 into this one. And the next ETF is the top 40, the Cetrix top 40. And this one and the kept all share guys are down really bad. They're both down 7%. But I'm going to hold. They're so well diversified, and I believe that they will pick up as time goes. And also, the upcoming elections, I believe, are affecting the share prices because they come with a lot of uncertainty. People don't know if they should continue investing. Also, who's going to be the next candidate? Are they going to ruin the economy or improve the economy? So I believe that one of the factors is the upcoming elections. So I'm just going to continue contributing towards them until then, and we'll see how they pick up after the elections. So I'm going to put in 200 into each of them. And even the kept all share ETF, I'm going to invest 200 into it. And the next one is the DV ETF. And as I have mentioned that I'm going to shift my focus a bit from dividends to growth. What I was doing last year was to put any extra money into the Cetrix DV ETF. So it weighs a lot, but the problem is that it's weighing down on my TFSA portfolio performance. So that is changing this year. I'm quite comfortable with the money I have in it. I mean, it's still going to increase as I'll continue to invest. I just want to focus on it a bit less. And also, by year end, the amount I would have invested could guarantee me at least 1,000 in annual dividend income. That has been my goal, to build it up so that I can use the dividends to build up other ETFs. So I guess that's why dividends are so powerful. So I'm going to put in 200 into it as well. And then there's the Nasdaq 100, which is up 17.85%. And this is the number one best performer in my portfolio. So I'm going to invest 350 into it. And the next one is the Signia Property ETF. It has a dividend yield of 2.6%, which is very low for me. And when I chose this ETF, I didn't know how much its yield is. All I wanted was diversification. I thought because it's a property ETF, it pays a decent amount of dividends, and well, here we are. And I'm just asking myself if it's the right choice. I feel like I have started, but I'm just questioning it. And it's because it's a property ETF and it should all be about dividends. And a 2% dividend yield for a property ETF, it's not make sure for me, unless if there's something I am missing, you know. But I won't sell it. For now, I'm just going to keep on investing. So I'm going to put on 300. And that is 5.9 shares. And the last one I have is the S&P 500. I'm really looking to build this one. So the dividends that I'm going to receive from the DV ETF will be invested here. And any extra income I get, I'm going to put it into this ETF. My plan is for it to have way more than the Cetrix DV ETF. So today I'm going to buy shares worth of 350. And that's it on my January investment, guys. Thank you so much for watching. Don't forget to like, comment, and subscribe. I will see you in my next one. Bye.